Welcome back, everyone. Today's video, I'm going to be taking you inside of the tracker, the spreadsheet that I go into to track all of my dividends. But first, I'm just going to run through each of the stocks individually that are in the public portfolio. As always, this isn't investment advice, and this is also not an accurate representation of my whole portfolio because I split it up for mental accounting purposes. Maybe I'll talk about that in the future, but today we'll move on to this account. This account is designed, or the intent of this account is to provide me with a diversified and growing income stream, and where much of the capital is basically returned to me, where I can redeploy it into new growing companies that also provide yield as a decent part of the investment outlook. So with that, we will go to the first company that actually pays a dividend from this account, that being Propel Holdings. Now, you may have seen the last video where I spoke a little bit about it, bought the first shares in this account. 5 shares pays 27 cents a month, so big bucks. And the reason is this company has high return on equity and a reasonable valuation. I think they have a shot at growing pretty decently, and they pay out a decent amount that hopefully can grow over time. Number 11, again, kind of not really that big a position in this account. 14 shares of Melcor Development. It's the type of thing I'm trying to half move away from in the account, in that part of the thesis is that it's value. And I think there's a lot of value there, but I'm trying to make this account something different from that. But these are some shares that are there, and I think with the growth plus the dividend, if they ever achieve the value that they should, well, that covers many years worth of growth or whatever afterwards. The first real stock that actually pays me a somewhat relevant amount of dividends is First National. I have 50 shares of First National in the account that pay $10.41. I really like how they're able to, there's a number of stocks like this in the account that basically grow a little bit, pay out a lot. And capital light growth, they don't need much capital to grow, and so get a pretty decent yield plus some growth on top. And First National, the $10.41 excludes a special dividend, which most years will arrive, so hopefully there's more this year. At number 9, we have Linamar. Linamar probably doesn't belong in this account, realistically, but I had it in from a while ago, and I still have it because I think it is significantly undervalued. Possibly the topic for a future video, but I think it's stealthily quality that should be fine in this type of account, even if it's not the core thesis of this account. But I have 152 shares that pay on average $10.66. That makes number 9. Number 8 is Toronto Dominion. TD. Unfortunately, it's one of those things that you can't, well, you can buy it often. I mean, I can buy it often, but it rarely gets to a point where it seems like a obvious buy that I should shove money into. It did get to that point to me, or starting to get there, I should say, back when they had all of that management and the clawback for management, changing management, the whole problems and all that stuff, when the stock was tanking, all that fun. Well, maybe not so fun if you're management, getting thrown out and having bonuses clawed back. But there was a lot of discussion on the stock, and this is the exact type of stock that I wanted to have in this account, whereby buy it at a decent time, hopefully, and then just ideally forget I own it. But so far, the shares that I've bought, 50 shares, pays on average $17.50 per month. Next, we have Nexus REIT. Nexus is, well, the beginning of the problem that you'll notice I have in this account. Problem being, I like real estate more than real estate seems to like me. But Nexus is one of those investments where I've been adding a bit recently. It returns a lot of capital at today's yield, plus there's growth potential, mark to market, and just over time keep it able to grow, develop new projects, turn some of the portfolio to places where the capital might make more sense. And I think that overall it allows for some growth plus a lot of return of capital. And this is actually return of capital, or has been for the last few years, which is much more tax efficient than, well, short term, more tax efficient than most other forms of distribution. But again, 9% yield, some growth, works. Number 6 is, well, a similar thing, MCAN Financial. It is a mortgage investment corp, which, okay, so unlike Nexus, the distribution here is fully taxable, so it's not even an eligible dividend, it's just income, which is less good. But Nexus, or MCAN, I should say, the 250 shares I own pay $34.16 a month of income, which is about almost a 9% yield. 9% yield sounds like a lot, and it would be a lot for a dividend. For a mortgage investment corp, that's its whole purpose. It has to pay out most of its income, and that's just what it does. And it did that last few years, while it was also able to grow its distribution by about 5%. So if they could do that on a regular basis, the 9% yield plus 5-ish% growth, it begins to be a reasonable investment. Plus, on MCAN, all of the shares that do drip from fellow investors drip at a price above NAV. So while they do have to pay out all their income, they actually keep a lot of that income in a weirdly tax efficient manner for them, where they pay out at NAV, and people and they keep more capital. It's kind of tough to explain, but they effectively issue shares above NAV and pay out dollars, so they get cheaper money. The 5th largest position is Alaris. I've spoken a bit about it in the last few weeks' stocks I'm buying videos, and that was adding to an existing position. I have 330 units paying $37.40 a month, and the reason that I like it is because it provides a nice mix and I think a solid IRR with a fair bit of distribution yield and even more growth. While I do think there's upside, the main point that I like about this is if you were to look at if they were to get to their NAV or above NAV, and they were to normalize the payout ratio to where they plan on having it, not only do they have solid return on their investments, but they also have the ability to pay out even more, and in possibly a tax efficient manner if they continue doing it as they've done, which basically means if it works, I get a higher yield to continue to redeploy into fresh ideas. And in the meantime, you get extra growth. So I really like the outlook from that. Number 4 is Strathcona. Strathcona is the only commodity company presently in the Canadian side of this account, at least, and I have 424 shares at the time of this video that pay $37.45 monthly. Again, excluding a potential special dividend, which at what I think is a more normal oil price, I would expect a special dividend, probably more meaningful than what the normal dividend is, and it could be one of the larger dividend payers. I mean, it already is at number 4, but I mean, it could be even higher up the list. Now, here again, the core of the thesis is I think management on this is pretty good. People have asked, I mean, I expected the question actually, but someone did ask it last time, why not just go with CNQ? And the answer is that I think Strathcona has more buffer and more valuation upside to reach CNQ. And I think, honestly, management has been comparable. Management's been pretty good on both. But it's harder for something the size of CNQ to keep growing, whereas I think Strathcona could. Or I'm perfectly happy with the yield that I think Strathcona would have, just giving the capital back to me and allowing me to say, okay, now's the time where I want to buy oil, or don't, or whatever. I'm fine with that. Number 3 is Brookfield Infrastructure. Now, this is one that I'd bet there would be a lot of people that wouldn't like, and other people that might be fine with it. Now, the reason why I think the Brookfield Infrastructure is a fit in this account is because Brookfield has access to capital. So in addition to their infrastructure being something where there's always projects that require heavy capital to invest, to grow, to earn decent returns, I think that the hope is that Brookfield, through this fund, will be able to provide yield, provide growth, and when they're purchasing something, they have options on how they're going to fund it. They can fund it with cash on the balance sheet. They can fund it with debt, or with any purchase they make, if their shares get too overvalued, they can easily fund the purchase with equity. And so the hope is that they can manage around that and keep growing the per share value in whatever way is the best at the time. I have 348 units that pay $69.60 on average per month. That may be slightly out of date. That was based on a recent foreign exchange number. They pay in US dollars, so I converted that, but it's probably a bit different. Number 2 is Dream Unlimited. Dream, I have 1,700 shares in this account, and it pays on average $92.08 per month. This is an undervalued core thesis, but my hope is that that's not the crux of the thesis. My hope is that Dream Unlimited goes back to, continues growing and has the market, or at least the cash flows, reflect that. And so either the stock can grow substantially, or they can pay out more and more. I would prefer buybacks on this one, but they don't seem to like them very much. And well, it was in the account anyway, so it is technically a dividend stock now, despite what would probably be better, in my opinion. But anyway, solid fundamentals, good business, and I think they can pair the capital light growth with the capital they retain, can earn some decent returns, and so great fundamentals for many years to come, I think, and with waves along the way, of course, but that's why I like it. Which leads us to the number one dividend payer in this account. And it's not exactly a dividend payer. It is Artis REIT, where I have 3,150 units that pay $157.50 a month. Again, this is one that returns a lot of capital through both dividends and buybacks. Buybacks being hopefully pretty accretive at something in the neighborhood of half of what their private market NAV is. And I'm sure there's going to be all sorts of thoughts on what private market NAV means in that very little. But returning capital and undervalued, again, something that was here from before I decided that this is the direction that I'm going to take the account. But realistically, I think that the value plus their willingness to arbitrage the market and deploy capital into not only assets but public market equities when it makes sense, I hope that from here they could earn decent returns or growth of NAV per unit while keeping paying out a decent yield. Now, at this point, you may have been counting in your head and you may have noticed that it doesn't exactly equal the $403 per month that I said I was making. It's a little bit more, and that's because of something that I'm going to talk about more in the future, but basically the account also has $95 per month in interest charges that on a little bit of leverage that is in the account, and I'll talk about that at its own video in the future. Now, the main thing is the first obvious statement is with 12 holdings, 2 of which don't even really count. I obviously need more. Moderation is something I'm not very good at, and part of the reason that I'm doing this and making it public is to kind of, push myself to kind of add slowly over time and just kind of look at different things and be less stringent on only having a few bigger positions. But now, let's jump into the spreadsheet itself and more comments on this on a portfolio level. And this is everything I just mentioned, all in one chart. Basically, the company name, the ticker, number of shares, dividend, annual income, monthly income, weekly, daily. I'm neurotic like that. And then I have how much it could grow next year, the income or the dividend, I guess. And not all of them will be correct because sometimes I don't think they're going to grow the dividend, but I think they're going to grow intrinsic value by that much. And then that's what the growth would mean annually, monthly, and the percentage of the income. Don't know why 8 cents shows up there, but it does. And then the sector, where you'll notice I have too much real estate. Need to fix that, but realistically, I can, there's an excuse for for real estate if I needed an excuse. I don't, but the reality is when you're looking at stocks in Canada, there's something like 75 that have more than a 4% yield, and something like 23 of those are REITs, and then you add in the MREITs, or the mortgage trusts and all the trusts, and you're close to almost at half. So there's that, and then there's the fact that I fundamentally like real estate and it's undervalued right now, and the final point is a long meandering point about rates that I won't get into. But yes, what was I at? I was at, and yes, then the last part is the eligible dividend versus capital gains. I need more to focus more on eligible dividends, frankly. There's a lot of other stuff that is less tax efficient, and I need to work on that. And also that stuff changes every year, which is a bit of a pain, but okay. And then as the portfolio goes, this is what the chart looks like of the income. And again, you can kind of see 31%, 31.6% artists, 18.5% Dream, 14% BIP, 7.5% Alaris, 7.5% Strathcona, and then it just gets progressively lower from there. Again, because income is fungible, once it comes back to me and can be redeployed elsewhere, this makes it beneficial to have more positions, rather than when growth is a bigger part of the equation where you'd want to have fewer positions. Here, I really think that if most of the return is based on deploying capital and getting a good yield on that to start with, then I can have many more positions and have a more relaxed type of portfolio. Now, the other thing that I was going to show was the cash flow. And this is what the cash flow looks like. This is how I think about capital deployment and where I'm at. These are the, in green is the revenue that I get from dividends and distributions. The red is the costs, so that's the margin and the interest on that. And then in the blue is the net cash flow from continuing operations, if you will. And then following that is how much I'm adding bi-weekly, or that equates to whatever per year. And the following is how much investable free cash flow effectively I have. And those numbers, you see the 1.6, whatever, that's the multiple, that's my net debt to EBITDA, I guess you can say. So it's, I think, pretty manageable, 1.6. And this is basically how much you follow that line, and it's investable free cash flow. It's, how much per year, per month, per week. And on the weekly, that's kind of my rough target. In a neutral market, I'd deploy roughly that. In a expensive market, I might deploy much less to lower down the debt number and kind of give me more dry powder for later. In a cheap market, I might keep the leverage at 1.2, 1.25. That's kind of my soft cap. I don't really want to go super levered, but when there's some stuff, that's kind of how I look at it. But anyway, that is basically, and then the last two lines are, theoretical plans and how much dry powder that would leave me with. But that is what I wanted to cover in today's video. If you have any ideas of stuff that might fit in the portfolio, any questions, any comments, gladly listen to them and answer if I can. And until next time, thanks for watching. Have a great day.